All right, so thank you everybody for being here. We are here for the second part of the day. We have my presentation now for about 20 minutes or so, and then we have our last fire chat. And after that is the happy hour, which I know you're all waiting for. So what I'm going to do today, I'm going to give you a real brief overview of the real estate market. I'm going to start with it's a macro approach. So I'm really going to start with just talking about the economy in general, and then going from talking about economy, diving a little bit deeper into real estate, and specifically real estate, where real estate is going. So the outline, like I said, is the macroeconomic outlook, talking about economy, real estate market conditions, and the outlook, which is where we're going in the future. I'm going to start with this slide, especially because we're after the elections, and I don't want to get political in any way, but of course, you know, when you have two candidates running for presidency and the race is close, you know, we're 50-50 basically between who we want to be elected, and then we have a president being elected. But really the most important thing is, if you look at this graph right here, it shows you how far the US have come over the last 100 or 120 years or so. So, and that is under presidents who were Democratic or Republican presidents. Just in the year 1900, the US was about 16% of the US market cap, of the global market cap in terms of investments overall. And today we're about over 60%. And that is not only going from 16 to 60, which is tremendous, that is also over a period where the rest of the world grew tremendously. I mean, we have investment coming from China and India and Europe really receding a little bit, but with everything that happened over 100 and some years, you see US that is going from 16% to 60%, and that's really mean a lot for you know, who we are. We're hardworking. We're people that are have dedication to what we do. We are United States. It's not Spain. This is not France. This is not where we're not working right now because it's siesta time. And I think that is showing this number. So the one thing that I will start the presentation with is never bet against America. We are going to do great. Now let's talk about how we're doing right now. So first of all, let's talk about the good side. So basically the fact that the United States of America, the people here in the US, they do have money. If you're looking at the wealth that we have here, and specifically the graph I'm looking at my left, I guess it's your left also, looking at the segments in the ages that people that already accumulated wealth, let's say 65 to 74, we have about 1 in 8 people have a wealth of over $5 million. That is real wealth when you talk about 1 out of 8 people. That is for educated people that went to college. If you talk about people that have not went to college, the number is of course a lot smaller, but we're talking here about FAU graduates and people that probably have some education. 1 in 8, that's a very large number. If you're talking about the same statistics before COVID, it was about 1 in 20. So over the last 5 years or so, the United States or the population here gained significant amount of wealth. And in addition to that, the unemployment rate is extremely low. I think that the highest unemployment level in the country is in Nevada, and that's about 5%, still very low. We are at a very low unemployment and creating a lot of wealth, so that means that we still have a lot of room to grow in front of us. On the negative side is how we're spending our money. So if you're looking at all income group, all the way from the people on the bottom, 0 to 20 percentile, 20 to 40, 40 to 60, all the way to 80 to 90. So basically among all income level, people spend more money today than they're actually bringing in. So when you see those graphs, those numbers coming down, that means we're spending more money than we're bringing in, and that of course cannot last forever. The only group, which I'm actually not showing here, the only group that is actually making more money than they're spending is the top 10%. That means that 90% of people in the United States, when they bring $1,000, $1,200 going out. That is not sustainable. So that of course is going to end at some point, and that's going to put drag on the economy, and we already see the evidence for that. And the evidence is that credit card balances are starting to go up, and delinquencies are starting to go up. And at some point, we'll see the effect of that rippling to the economy, and people will have to spend less because it's just the way it works. You cannot just spend more than you make for too long of a period of time. The other thing that's going on that's on people's mind is how interest rates are behaving. So it is not a secret that interest rates went up significantly over the last few years, okay? We know that interest rates were 3% or even below for people that borrow to buy a home, and then they went all the way up to 8. Now they're around 6.5 or so, depends on what type of mortgage you're looking at. But more importantly is the spread between what interest rates are and what is the 10-year treasury. Historically, that spread was about 1.8, 1.9%. Recently, that spread was about 3%. Okay? And that spread is not just something that is there for a short period of time and came down, like it happened, for example, 2008, or happened during the beginning of COVID in 2020. This spread that is very high is been high and staying high for almost 3 years now. And that means that even though interest rates, borrowing rates are quite high now, there's a lot of hope that even with rates for 10-year treasury stay where they're at, borrowing rates will come down. So if you take, for example, 10-year treasury and changing all the time of about 4.2, 4.3%, you add to that 1.8%, you should be at 6% mortgages right now. And if you see some softness in the economy, you're probably going to see rates below 6%, and that's where we should be. I'm not saying that people that are talking about 3%, they're probably not going to see it anytime soon, but rates in the sub 6% are very doable given the current economic situation. And again, now that we have a new president and there is some uncertainty removed from the equation, we're probably going to see it sooner rather than later. The other thing that is important to see is that people talk for a long time about economic soft lending. What do we mean by soft lending? Basically, the fact that when interest rates, if the Fed is increasing interest rates and the economy is not tanking, okay? Typically, when you have an economy that is doing, too well, or inflation is running high, the Federal Reserve is increasing rates, and then they try to decrease it slowly without hurting the economy. If you're looking at all recessions in the past, with the exception of two, one in the 1980s and 1990s, every time when the Fed is increasing interest rate, the economy is falling into recession, okay? The two times that it didn't happen in the past, in the 1980s and 1990s, we have a very long recovery, and the economy did extremely well for a very long period of time. We're in the same situation right now. The Fed increased interest rates significantly, and that's why we went from 3% to 8%. Now the economy did not get under recession. Now the Fed is decreasing interest rate in order to stabilize things back again. And that is, to me, a very good sign that we have, again, a long runway in front of us for the economy to continue to do well for some time. This is not just about some random statistics about, what happened with interest going up. If interest rates are going up and the economy is not going into recession, it means that it's resilient. It means that there's a lot of robustness there, there's a lot of productivity there that cannot go away with just increasing interest rates. So I'm very bullish about the US economy. Let's talk specifically about real estate, because that's what we're here for. So again, if you're looking at the fundamentals, vacancies remain low. Typically when you get into a recession is when you're building too much and you see vacancies starting to climb. Of course, we see vacancies of office going higher, and we know this is something that is separate from real estate. It's just the whole, working from home and how people use offices, etc. That is going higher. But if you talk about apartment, industrial, and retail, vacancies are quite low and stay low. That is especially true here for South Florida. I mean, we heard people talking about it, that, when you talk about people that have problems renting places and increasing rent, etc., they're like, what are you talking about? Well, oh yeah, if you're from out of South Florida. But even outside of South Florida, the retail, industrial, and apartment segments are doing quite well. Office is lagging, but even when you read the headlines about office, when you hear that Amazon and companies like Amazon are basically saying you have to come back to the office, this is not just one-off. That is becoming something that a lot of companies during COVID realized that yes, there's something you can do via Zoom, and a lot of things you cannot, so come back to the office. And we have to do things the old-fashioned way to some extent. And I think that a lot of this office space that we're suffering for some time will probably see a renaissance period pretty soon. Talking about annual NOI growth, so how rent are growing, consistent with low vacancy, we still have quite healthy NOI growth. It is not as high as we had in 2021, 2022, so we don't see those huge increases, but still all across 4 sectors of the real estate market, we see real estate rents continue to go up. So why is that? Why do we have such strength in the real estate economy even though interest rates went up? If you had told many people a few years ago that interest will go up from 3% to 8% and we're not going to have a recession, they'll tell you crazy. If you tell them that interest rate will go so high and housing prices will not drop, they will tell you crazy. But if you understand why this happens, it will make a lot of sense. In the United States of America right now, we have a shortage of about 4 million housing units. That is more shortage than we ever had in the history of the United States. If you're looking at all the way to the year 2000, that is where the market was balanced. We built too many homes every year. That is when you see those blue lines are up, they're going positive. That means we built too many houses every year. And then we peaked in the year 2006, 2007, when we have a surplus of about 3 million houses. And then you know what happened? We went into a recession and people stopped building. Basically, the music stopped. Nobody built anything. So we stopped building and then we build less houses than we need every year. And that's when those graphs are coming down. And we're balanced around 2012. Since 2012 until basically last year, we build too few houses compared to what we need. And we're balanced in 2012. That means that for over a decade, we build too few houses than we need. And that created a shortage of about 4 million units. By the way, out of those 4 million units, about 300,000 units are here in Southeast Florida. Between Palm Beach, Broward, and Miami-Dade, we have a shortage of about 300,000 units, and that is what makes this market so resilient. So where are those people living? You know, they don't live on the street. You don't see thousands of people living on the street. Well, one place they live is that they live back at home. So we have a very high percent of people that is still staying with mom at her basement. Okay, so 35 to 45-year-old, 25 to 35-year-old people living at home in a higher rate than almost ever before. Average is about 12.5%. Now we're looking at 16%. It's significant. And then if you think about it in terms of demand, there's something else that's happening. The picture on the left is showing how household is shrinking, and at the same time, housing size increase. So it is not, and I should fire my graphic designer, or maybe I should hire one, I don't know. But that it's not very clear, but the story is clear. Looking back to basically year 1800, the average family size was about 6 people and lived in something that is less than 800 square feet. Going through time, today you have an average family house or household that's about 2.5 people, and the average new construction is about 2,500 square feet. So if you really think about what it means that not only you have population growth, of course, you have the population spread over more and more houses because there's fewer households in every home. And then those homes become bigger. That's by itself fueling demand. And that combined, of course, with short of housing, make housing very resilient. On the other side, housing has become very unaffordable. We know that. With higher prices and higher interest rates, that means that the average buyer is buying a home at a much, much older age. So it used to be, if you're looking all the way to the 1980s, people in their early 30s were the average buyer for a new home. Today, it's people in their 50s. Again, that cannot grow forever. You cannot increase the age to 60 and 70, whatever. I mean, at some point, first of all, they live somewhere. Whether they buy a home or rent a home, it doesn't really make a difference in terms of demand. But in terms of the age of when they buy a home, there's a limit there. And that is what I call pent-up demand. It's people that want to buy a home in their 30s or 40s, just can't afford right now. But as soon as interest rates come down a little bit, as soon as maybe housing prices do not go up as fast as inflation, they will have the ability and they will bring the demand for that. And that's, again, why I'm bullish about real estate in the United States and here in Southeast Florida. Looking at the supply side, a lot of people are worried about too much supply for apartments. So look at that. Basically, the peak of construction for multifamily happened in the year 2024. So that the worst is basically behind us. Looking at the year 2025 and on, there is significantly less inventory that is coming in the market. This is not me guessing. I don't need to have a crystal ball in order to know that. All I need to know is how many people start building 2 years ago, because I have all the data about permits, etc. And I know how many properties will be finished in the next year, 2, 3 into the future, because those projects, on average take 3 or 4 years to be completed. So we have a lot less supplies coming in the market, so that is addressing that, spurt in demand in supply that we have in the recent year. And if to put it in context, if you're afraid of too much multifamily, you need to understand, number one, it's what people want. A lot of the young people that used to want, like, I think, Mr. Hollo, or Austin Hollo, because he said there's only one Mr. Hollo. Austin Hollo said is that they wanted the house with the picket fence in the suburb. Now they want to live in the center with amenities, etc. So this is what people want, and that's why the multifamily addressed that. And then you have to think about it, that the multifamily only accounts for about 18% of the overall housing units. Think about it. In the United States of America, there's about 130 million homes. Only about 21 million of those are multifamily and condos. I know if you look around Brickell, it looks like 95% of homes are multifamily and condos, but not everywhere is Brickell, okay? We're having the wrong perspective on those things because where we live. So even if you build a little bit too much for a little bit of time of that multifamily, you're still talking about a small percentage of the housing that is built a bit too fast. Now, where do people look at housing in terms of, when you ask the average person, you ask him or her, should you buy a home now? Or do you think that housing or buying a house right now is a good idea? So again, what you see, and that is the graph on the left, right now, if you ask the average person, is it a good time to buy a home, yes or no, 88% of people will tell you it is not a good time to buy a home. Okay, 12% will tell you it is. The other 88% will tell you it's not. The last time that we saw anything close to that was in the year 1982. At that time, 85% of people said it is not a good time to buy a home. Anytime between that, we're looking at probably about 70% or so will tell you it is a good time to buy a home, and only about 30% will tell you not. Now, why does it matter? I mean, those people are not experts about where housing prices are going, but still, they're the one, if you think it's not a good idea, maybe they will not buy a home. I'll tell you what happened in the early 1980s. Right after people said it is a worst time to buy a home, that is when we have the best runs in real estate prices in US history, okay? And if you look at the graph on the right, it tells you that people tell you that it's a bad time or a good time to buy a home, not because that's really what they believe, it's because what they can afford. When people cannot afford to buy a home, they will tell you it is a bad time to buy a home. And the last time, again, when you see here in the early 1980s, we go below that dotted line. That's the last time when affordability was as low as it is today. People cannot afford to buy a home and therefore say it's not a good idea to buy one. Today is the same situation. Housing prices are high, interest rate in relative terms are high. People cannot afford to buy a home, so they say it's not a good idea, but that does not mean that that is the truth. Putting in perspective where Miami is, so I have here two graphs. The one on the left is talking about the median price. So yes, Miami has become a lot more expensive recently, but it's still significantly cheaper than cities like New York, Los Angeles, and Washington, D.C. We are basically the fourth more expensive city in terms of median sale prices. Yes, it is true that Philadelphia is cheaper, Atlanta is cheaper, Dallas, Chicago that is full of violence and whatever is happening right now, but this is not Miami. Miami is a true gateway city, and there's a reason why it is so expensive. Now, if you're looking at the right, you'd see the price appreciation since the year 2000. And basically, Miami outperformed all 10 gateway cities in the United States in terms of appreciation over the last 25 years or so, and it is for a reason. Like people said before here, Miami used to be a very seasonal city where people come here for a little bit and then go back when the weather turns, and now everybody wants to be here. So this really become a location of choice. I talk about it a lot. Let's talk about where the market is going. So the investment outlook. So this is more on the investment side. So the graph on the left is talking about, again, US securitized commercial real estate loans. So a lot of people talking about how the loans that are being matured cannot be refinanced, right? People borrowing money, they borrowed at 3-4%. Now the loan is coming to mature, they need to refinance at 7-8% or whatever the rate will be. It's difficult to do. Again, 2024 was the peak of the maturing of loans in the United States. That means we passed that peak. There's less loan maturing in 2025, and therefore a lot more equipped in order to handle those. Not only more loans are maturing, also rates are a little bit lower, banks a little bit more lenient, and there's plenty of cash on the sidelines. People are waiting for a recession for a very long time, so when those assets, if some of them need to be sold, somebody will come and buy them, even if it is for a small discount. And then you look at the graph on the right, that is the price of commercial real estate. Combine all sectors, between multifamily, industrial, retail, et cetera, et cetera, et cetera. We already have a decline of about 20% in commercial real estate prices. So if you bought an apartment building in Miami, Class B, 2 years ago, you probably pay a cap rate of 4%. Today, you can get the same building for a cap rate of 5.5%. And the same thing apply everywhere else. Really, if you're looking at cap rates, they went up probably 1.5% over the last 2.5 years. And at the same time, rents went up, but not quite as much to offset that increase in cap rates. So overall, we have a reduction in price of about 20%. And if you combine it with, again, less loan maturities, interest rates stabilizing, and the overall low vacancy, it's probably a turning point right now. And I see that from now, probably we're hitting the low point of commercial real estate, and we start going back up. If you're talking about the kind of returns you can make in real estate, I think this graph is very interesting. So think about an individual or investor that is buying just what I call plain vanilla investment. Nothing special, not any particular value add or redevelopment, anything like that. You just buy a property for a cap rate of 5.5%, which you can find here in Miami and other places too. If that property, you can increase rent on average at 2.5% per year, now you have 5.5 plus 2.5%, then because interest rates come down, at some point in the future, and here we're talking about 5-year holding period, you can sell that property for just 0.5% cap rate lower. So instead of buying it at 5.5, you'll be selling it at 5%. That will add almost 2% for your return. And then you're borrowing some money. Let's say that you borrow 60%, which is again conservative, and let's say you borrow at 6%, which is also possible. That will add another 4, almost 5% to your return. Altogether, if you just buy this average deal without anything special, you have a return of about 14.5% per year over the next 5 years. People don't realize that. When they buy real estate and say, okay, so cap rate is 5.5%, I can just put my money in a CD, get 4.5%, it's not the same. If you know anything about compound interest, 4.5% versus 14.5%, it's not 3 times as much. It's, depends on the whole period, 100 or 1,000 times as much. You cannot even begin to compare, especially if you adjust it for inflation. So really opportunities today in the market to buy today when interest rates are still somewhat high. Wait, eventually we're going to get to a recession at some point in time. At that point you refinance, maybe later on sell if you need to dispose of the asset. You can still make very good returns even on a plain vanilla investment. Let's think about what investors think about overall market. So basically when you're talking about investors, those are professional investors that you ask them, have we hit a bottom or not? We're talking about when we're going to hit the bottom in terms of real estate, commercial real estate prices. Take the top two, between 38% and 18%. Over 50% thinking that it's going to happen before the end of this year. And almost no people thinking that the bottom is more than a year ahead from us. So basically, right around now, whether it's this quarter, next quarter, we hit a bottom. This is the time to go shop for real estate. Let's think about what the market thinks. So there's one thing about to ask investors what they think. Another thing is to watch what they do, right? Sometimes people don't tell you what they really think, but if you watch what they do, you know exactly what they're thinking. This graph is showing you the difference between what public market is traded for, that is what people buying and selling real estate investment trusts, and what the private market is traded for, that is what people buying and selling individual properties. And only a year ago, the spread between them was 1%, sometimes 1.5%. When you're talking about cap rates of 4%, let's say on multifamily, and you have a 1% gap, okay? So instead of 4%, the market for private is 5%. The difference between 4 and 5% is 25%. So just a year ago, the market predicted a 25% correction. I look at the people that work with me in my consultancy, they realize that I like this index a lot because the public market is predicting the private market. Here he told you basically that the real estate will go down about 25%, and it did. Well, it went down about 20% on average. Today, if you look at the spread between them, it's basically zero. It means that we reached the bottom. The public market is very forward-looking. When people buy and sell REITs, they do it every day. The price being turned early, and it tells you what's going to happen in the next 6, 12, 18 months. And right now, it tells us that we basically hit the bottom. And last but not least, what do I think, right? We talk about what investors think, what the market think, what do I think? I really do think soft landing is very likely. And now when we have, again, new president, and so that uncertainty behind us, we have interest rates that are somewhat more reasonable, and we have a resilient economy, especially from the real estate perspective. So we have an extended economic cycle that is very likely. The fundamentals are solid and remain solid for a while, simply because there is shortage of real estate. And you cannot create real estate from today to tomorrow, okay? And you cannot ship real estate from one place to another if you have shortage in one place and a surplus somewhere else. Rate and inflation rates are creating a window of opportunity. Don't delay buying real estate because interest rates are high. Buy real estate because interest rates are high. That means that when they're going to go lower, you're going to be able to refinance, because they will at some point. You're going to be able to refinance, and you bought prices at yesterday prices, and you finance them at attractive rates at some point in the future. And the last one is that investor with medium to long-term horizon will fare well. If you get into a property or into investment in order to sell it a year from now, I don't know what's going to happen. It's too short for term. But if you really are buying an asset in order to trade it again in 5 or 10 years, you're going to do quite well, assuming that you buy it at a fair price. Thank you so much.
Thank you, Eli. So I'm sure you've learned a lot. There's a lot to unpack there. Eli, I can attest, is just, you're a wealth of information. Don't go anywhere. We're not done with you quite yet.
Okay.
This is our opportunity, actually, when it comes to Q&As, with this kind of presentation, this kind of understanding of the market, Eli, and knowing both, obviously, the commercial and residential, what we're learning here is incredible. And we've got some time for some Q&As right now. So I'd like to open up the floor. Please come with your questions, because this is the moment, this is where it impacts you directly. If you guys are out there and you're thinking about your own reality, what's incredible is that what you're learning here today, what you're feeling, does not hit the media, does not come out till later. This is real analysis happening right in the moment, and being really on top of this. And there's so much misinformation out there. This is going to arm you. So please, let's have some questions for Eli, and we're all going to learn some more. Okay, lady here, please.
Hi. So I invest in multifamily in the Hialeah and Little Havana market. And you ended your presentation by saying, as long as it's a fair price. I am finding that it's very difficult, especially with long-term owners, to actually make any adjustments on their pricing from the 2021, when rates were very low and prices were rising. What have you seen, or what are you predicting that's going to happen with those assets that have been held for a very long time? They don't have mortgages, so there's not any refinancing. What can you speak to in regards to that?
So yeah, for sure. If you talking to the typical Miami seller, it's like, this is my price, and if you don't like it, go somewhere else. And guess what? In 80 or 85% of the time, you should go somewhere else. Because a lot of those buyers are unreasonable, they don't have a reason to sell, they believe in Miami long term, so they don't sell. But in many cases, we have a situation where there's a need to sell. I do see, and I'm working with some clients even right now, that the same asset that I know, I would probably have to pay 20 or 25% more if I would buy it in 2022. I bought it today, or on the contract today, to buy them for 20 or 25% lower than it was then. So it's not every asset, especially in a place like Miami, but you can find them. I could not find assets, talking about multifamily, I could not find assets that are much above a true 4% cap rate in 2022. Today, you can find assets that are true above 5%, same quality, occupied, area that is growing, etc. I like the areas that you're focusing on. They have a lot of potential. You can find those assets that are true above 5%. And if they're in good conditions overall, if you're in an area that is growing, you can basically do with them whatever I just told you, right? I mean, if you have decent rent growth, if you're leveraging just a bit, if interest rates come down a bit, you'll be making good returns. Are you going to be making 20% a year? Probably not, but somewhere in the mid-teens or close to the mid-teens is very doable.
Okay, next question. Yes, gentleman over here.
Hi, how are you? Thank you very much for the presentation. I think it helps us all a lot because economics is one topic that it's hard to understand, so I really appreciate it. But my name's Jose. I'm in residential here in Brickell in downtown selling pre-constructions and new developments, especially just we had cut rates yesterday. How do you go about those conversations with clients that are international that don't really know a lot about the economic, system that we have here in the United States? Because that's one issue that I've had, with previous clients that weren't very sure how the system here works.
Well, I'm sure that a lot of your clients are coming from Latin America, South America, and I think that the first thing that the reason they're coming here is for safety, for security, and for stabilization. So there's no question that the United States is a much more stable place in terms of the economy, the currency, and the physical security aspect than most places around the world, definitely in Latin America, South America. So that is the first thing you're going to be selling on. The other thing, and I learned that a long time ago, is that people sometimes buy in certain places real estate because they bet on the currency and say, you know what, you should buy in, you name it, Brazil, because the currency there is very low, so it's going to go back higher and you're going to be making a lot of money. The currency market is so efficient and so unpredictable that if you want to play currency, go be a FX trader. That's fine. I don't recommend that, but that is a much safer way to play currency. If you buy real estate, you should buy it because whatever it is. If you buy in a place like Miami, and if you believe that demand here will continue to, come, again, Austin was telling you 50% of new leases are coming from outside Miami-Dade. And by the way, I didn't ask him, but I bet you these are not people coming from Broward here. Maybe a small percentage. These are people coming from New Jersey, from New York, from California, from Boston, et cetera, et cetera, et cetera. There's growth here. Even if you overbuild for some time, you're able to get out of that. So not everybody able to time things perfectly. So maybe you're going to be buying at a time that maybe it's not the best time to buy. But the fact that you're buying in a place that is growing, this growth is going to get you out of the trouble. And I think the real thing that's important about buying assets is the ability to hold to them. And the only way you can do that is if you don't over leverage. Students here that take my classes, they know how much I talk about leverage. Leverage is important to do at some level, but very little, because if you take too much leverage, if those people borrowing too much, they're basically putting in a position that they have to sell the asset at some point, and maybe that is not the right time to sell it. So always advise them to be able to buy something with very low leverage.
More questions? Yes.
Hi, thank you so much. I have a question about...
There's a microphone right by you. There you go.
Thanks, maybe that's better. I'd like to ask your perspective on the future of South Florida retail commercial real estate.
Okay, so retail is actually one of the brightest spots of commercial real estate. If I would advise to go into two places in real estate in terms of sectors, that'll be multifamily and retail. Now, I know a lot of people talking about retail. So multifamily, you understand. I just show you a graph that there is a shortage of housing. That's simple. You have shortage of housing. A lot of that is here in South Florida, but in many other places. So that's kind of complete the argument for multifamily, again, for the right price. And I think the prices are there. On the retail side, you have to think about, for a very long time, probably from, 2012 or so, there's a lot of this conversation about retail is dead, right? Everybody's going to buy everything online, and all the stores going to close up, and therefore we don't need any of them. And guess what it did? What it means, or what it did, is that nobody built any new retail. And what you saw, because of over a decade of basically, there's very, very limited construction of new retail. Some retail, the B-, C-class closed and got repurposed. You have now the lowest vacancy level of retail that we saw in decades. And retail are doing very, very well. If you're really looking at NOI growth, especially if you're looking at the A-, B class, doing extremely well. I'm very bullish on retail. And it's selling for attractive valuations. So if you can buy multifamily for 5.5% cap, 5.25%, 5.5% cap, you can probably buy the same quality on retail for 7%, and the math is similar. You can probably making even an extra 2 or 2.5% return, again, on a plain vanilla investment.
Okay, more questions? Yes. We have over here microphone coming to you.
Hi. So recently, a lot of CEOs came out that said that in the world we have a lot of inflationary pressures, even though inflation's coming down. Like a lot of big corporations are moving operations to more geopolitically friendly places, especially out of China. And you also have the government running over a $2 trillion deficit. And especially Jamie Dimon has came out and said this could contribute to higher inflations. How does that play into returns for real estate?
I love this question because, a lot of the arguments that I'm making here is about, buy real estate at fair prices, wait for a recession or for interest to come down a bit, and then being able to refinance, and that's how you can recognize some decent return. And then the question is, well, what happens if interests don't come down? What happens if you have inflation, right? Typically, when you have inflation, interest rates stay high or even go higher. The good thing about real estate is that basically you get a hedge against inflation. About 45% of the CPI, the inflation measure, consumer price index, is coming from real estate. That means you cannot have inflation without increase in real estate prices. At least you cannot have it for too long. The two are very, very highly correlated. So if you do have inflation, and I do agree that it's probably not going to be sub 2% like we saw in the 1990s, it's probably going to be 2.5%, maybe even touching 3% for some time. It's going to be hard to tame it unless if we're getting into a recession. If you do have inflation, that means you're going to get the return on your property, on your investment, from price appreciation, not necessarily from being able to refinance. But still, you're going to be making decent returns.
Okay, there's a lady right here in the front who had a question. No? Okay. You do? Okay.
You mentioned that you're bullish on the Southeast Florida market. Are there any other markets you're also bullish on in Florida?
Well, in Florida specifically, I think you have to be very careful now going to places like Orlando, Tampa. In those places, you don't have the same limitation of construction we have here in Southeast Florida. And a lot of those got too much construction over too short of a period of time. I'm not saying that those will be bad places to invest, but probably a little bit early. If I were to choose between investing in Broward or investing in Tampa right now, I would go Broward. Long term, I think you're going to see a lot of opportunities in the west coast of Florida and up north. But I think right now, for maybe some time, I don't know, 12, 18 months, you have to be a little more cautious. So if you're talking specifically about Florida, I like the Tri-County more than anywhere else.
Okay, question at the back of the room. Right, going to make you work here for your money all the way across the room here.
Hello, Eli. Thank you. One question, what can go wrong? Because everything sounds very nice, but there's maybe something that worries you. In your bad scenarios, what can go wrong and what should we be careful about?
Well, what can go wrong? Of course, every time when you have a recession, everything goes south, including real estate. But really, if you think about it, of course, things can go wrong, right? You can buy a property that is structurally unsound. You can have insurance prices, people talk about it, that can be sometimes out of control and maybe can reduce your returns. You can have a certain shock to the economy, whether it's geopolitical wars, etc., that can hit the economy, create higher unemployment, and reduce rents. But really, if you're buying into an economy where the one thing that we all need, which is a place to live, a place to shop, we all need real estate, and there's a shortage of that, there's very little that can go wrong if you have enough staying power. I really do think that things can go wrong, but if you have good staying power, and if you buy something that everybody needs that it's in shortage, you're going to do just fine.
Perfect. Well, yes, let's keep them coming. Another question over here.
Yeah, I wanted to, from our perspective, we're
Where's it coming from? Sorry.
Right here.
Okay, all right.
Yeah. We own 1,800 units predominantly in Florida. And one of the challenges we've had when we underwrite deals is the negative leverage component, right? Because cap rates are at 5.5%, I agree. But you're still probably financing stabilized product at 5.75% to 6%, even with buy downs, which we have taken advantage of. But how do you balance that?
I think that's a mistake to look at it as a negative leverage. So there's two concepts of negative leverage. Again, I'm not going to be teaching here a classroom, but you have to remember there's a difference between the cash flow company investment, which is the cap rate, versus the financing. Probably that's what we're talking about. And there's the actual investment. If that investment can bring you a 2.5% increase in NOI, there's a very simple equation telling that the return is equal to the cap rate plus the rent growth. That is on an unlevered basis. So if you have a 5.5% cap rate and a 2.5% growth, now we're talking about an 8% investment. That 8% investment on an unlevered basis, if you finance it at 6, it still makes sense, especially if you have an opportunity at some point in the future to refinance it at 5. So the whole idea of negative leverage, comparing just the cash to the financing, I think it is the reason too many people are on the sidelines. I think there's a reason that now we have prices now that are lower than they were 2 years ago, and therefore probably a decent time to get in.
Perfect. Yes, over here. Oh, sorry. Sorry, can you say that one more time?
What would you project retail rent growth is between this year and next?
If you know something about how I make my predictions, I would never make a prediction between this year and the next. I always like to look at predictions because the correlation between how the economy is doing, what interest rates are doing, supply-demand imbalances, whatever geopolitical, it is so low between that and what rent growth that it's basically cannot predict it. It's noise. If you're talking about longer term, thinking about 7, 10 years, I think you can see a slightly higher than inflation rent growth. So if inflation is running at 2.5%, I think it's not unreasonable to see probably a 3.5% rent growth on retail, simply because it hasn't been built enough of it recently, and there's a lot of this repurposing of this retail for things that people really need, experimental, etc., like people talk here about earlier in the segment. So slightly above inflation.
Okay, another one right over here.
Thank you. Thanks for the assist. What do you think are some of the potential headwinds and tailwinds of a Trump presidency for commercial real estate? Only the easy
And I'm
ones
supposed
for
to
you.
stay unpolitical. I don't know if I can do that.
Evan's poking the bear.
I'm speaking for myself, but I am the director of the School of Real Estate at a public university. So I don't know how political I want to get.
Well, we could speak about the metrics. So you touched on inflation before. What about potential regulatory cuts that could benefit real estate? We keep it high level.
Okay, thank you. So
Thanks.
I think the market spoke, right? I mean, if you're following, financial markets over the last few days, the market, whether you like it or not, the market liked the fact that Trump is president. Okay, we saw asset prices go up, and you saw even increase in interest rate at the same time, even though the Fed decreased interest rates. So I think optimism is there. The fact that Trump or the Republican Party in general have a more business, the more favorable for business and removing friction, etc., that is of course good for the economy. I think all in all, that's probably a good thing. And most importantly is the fact that for a long time, we had a president that I think a lot of people were saying that basically is waiting to kind of phase out. And a lot of people waiting for that phase out. Who's going to be next? Who's going to take over? That is behind us. And I think that is what a lot of buyers, whether they are buying a home or whether the investors were looking for. Now they don't have the excuse, I'm going to wait for the election. Now they don't have the excuse to continue to wait. And I think that will wake up the market, residential and investment. So that's my take on that.
Okay, as a residential broker, and again, I know there's everyone in the room is a homeowner. A lot of people are homeowners, obviously, and living homes one type or a sort here in Miami, or at least in Miami-Dade. My question is for you, Ellie, and obviously we've discussed this. We're in a bifurcated market with a lot of different neighborhoods and a lot of different subsectors, and obviously there's a lot of data and a lot of analytics here and the understanding of the economy that shows that you're bullish fundamentally on as we move forward, and if we obviously recognize that interest rates are high, but it's the right time you don't want to buy with the herd. If you do what everyone else does, you get what everyone else gets. If you were to identify some of the sub-markets, do you have certain sub-markets that you could mention that you're bullish about, that you feel that have the right metrics that we should be paying attention to if we were home buyers or investors in those markets as a residential buyer?
Thank you for putting me on the spot. So I think specifically, we're talking about Miami-Dade, which we probably know better than other markets. I think we're benefiting from the two ends of the distribution. So on one end, you have Miami is a magnet of wealth, right, Dr. Hardin? Dr. Hardin's always talking about Miami being a magnet of wealth more than even a producer of wealth, is the fact that there's a lot of wealth coming from other places in large quantities, wanting the best place to live. That means that if you are looking at Pinecrest, Coconut Grove, Coral Gables, those markets will do very well because a lot of those people coming from other places with a lot of wealth, they will continue to pay very high prices. Then on the other extreme, then in the middle you have the working people that are struggling to buy a home, and then they cannot buy in the average neighborhood because still prices are high and interest rates are high. So what do? They go to the places that are cheaper. Those are the places that still geographically are good in terms of commute time, etc., and you can get them for a more attractive price. So when you're talking about areas where you're investing, like I said, Hialeah, Little Havana, etc., Homestead, those are the areas I think that are going to see a lot of growth in terms of price appreciation. Simply, they're priced significantly below the rest of the county, and there's a lot of potential to go up there in price. Yeah. So really, the two ends probably where I would be.
Yeah, we see it as a little bit of a lull right now, but I tell you, you can see the pent-up, I guess the pent-up demand, you can feel it. Buyers are out there waiting. Do we have time for, how are we doing on time? Okay, we've got time for maybe one more question, two more questions, and then we're going to move to the next section. So anybody else? Yes.
Hi, thank you for speaking to us today. I have a quick question regarding, I think we've seen an increase in the environmental risk, and especially in Sunbelt states like Texas and Florida, specifically, let's say in the multifamily asset class, mainly driven by the increase in insurance expense. I think in Texas, the average growth rate for insurance expense has been, I think, 20% since 2019, year over year. How do you underwrite that? How do you project that? And how is that going to impact the multifamily asset class in the coming years, in specifically those coastal markets like Florida and Texas as well?
So I said that, like the inflation question, I hate the insurance question. and the reason I hate it is because I don't have a good answer for that. First of all, I'm not an insurance expert, so I don't know what to tell you about where insurance rates are going. What I do know is when I'm speaking to some of the people that supposedly are expert in the insurance field, they're telling me that those increases that are well above inflation for some time are coming to an end. So if you trust anything what they're saying, we're probably going to see, we saw a hike in inflation rates that are adjusting for risk and all that, and they're probably going to be stabilizing over the near future. Also, if you think about it, banks, lenders becoming a little bit more creative about how they're giving loans, giving some of those difficulties. So a lot of lenders would waive certain part of the insurance and allow you to self-insure if you really believe that the risk associated with your asset is lower than what you pay the insurance companies. If you're large enough, you can probably do that and probably reduce your insurance cost. If you're small, that's a problem. You cannot really self-insure, even if the bank allow you to have the insurance cost. So I really think the key there is either to have enough size in order to self-insure and then negotiate something with the lender in order to remove that cost. Or hope that the experts are correct and those increases, the large increases are behind us and now we're going on a more stable path.
Well, thank you. I'd like everyone, please put your hands together for Eli Beracha.
Thank you so much.
Eli, I'm sure you can appreciate you're a wealth of information. It's incredible to see you share it with everyone and have such a detailed knowledge and a real understanding of what's going on within the market. Thank you so much.